Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morgia.
Hello, listener. Welcome to the show. This is the Making Money in Multifamily show. This is a Between the Sheets episode. I'm here with Rob Beardsley of Lone Star Capital, bringing Rob on to bring tons of knowledge to you. Today, we're talking about terminal valuations for your multifamily property and really how you can project those, how you bring in your exit caps and all that good stuff. So welcome, Rob. And just how do you go about, projecting your sale of your property? Because it is a lot different than the sale of, say, a residential.
Yeah, absolutely. So what we're talking about specifically here is typically when you're buying and underwriting a multifamily property, you're projecting a 5-year hold period over which time your business plan will change the property's income, hopefully growing rents, improving curb appeal, fixing deferred maintenance, making it a better property when you go to sell in 5 years. But during that time also the market can shift, and in the end, you want to project at the end of the 5 years a sale that will bring capital appreciation to you and your investors. And how do you calculate that sales price is through a simple calculation of net operating income divided by your exit cap rate. It's really no different than your going in valuation on a cap rate basis, which would be the trailing NOI or T12 NOI divided by the market cap rate, and that would really drive your going in pricing.
Yeah, so just like when you buy a multifamily property, buy a commercial property, a lot of it's driven on the numbers that you can derive from your NOI, as far as you're going to reverse that cap rate out and figure out your purchase price. So it's the same way when you sell it. So with that NOI comes a slew of things that you can manipulate. Rob, you mentioned cap rate. So before we get into the NOI, why don't we just mention, your buying cap rate and then your terminal cap rate and how you kind of find the difference between the two and project out that 5-year plan. So
yeah, and I wanted to add the point that the exit cap rate is harder to manipulate. It's kind of out there in plain sight, right? You can just look at the model and say, okay, well, what's the exit cap rate? And if it's 5, depending on what we're talking about, you might just walk away from the deal entirely and say, this is nonsense, But if it's 6, 6.5, 7, who knows, right? It might get you to say, okay, well, this seems kind of reasonable here. But in the end, it's one number, not as easy to manipulate. So the methodology that we go about calculating our exit cap rate is really just knowing the market real well and understanding what stabilized properties are trading at. The big misconception or an oversimplified way to look at this calculation would just be to say, well, whatever cap rate I'm buying the property at today, call it a 5 cap, I'll just increase that by 50 basis points and exit at 5.5%. But this gets distorted oftentimes because everybody knows that value add deals trade at lower cap rates than stabilized deals. So if I'm going in and buying a deal at a 4 cap because I see tremendous upside in the property, it would be really overstated for me to then project a 4.5 or even 5 cap on exit. So it really doesn't have anything to do with your going in cap rate unless you're simply buying a stabilized asset and you're projecting to sell a stabilized asset. So the real trick is to understand the property that you want to sell in 5 years in that condition that it's in. What are properties like that trading in the market today? So if my vision is to buy an underperforming property, renovate it, fix all deferred maintenance, improve curb appeal, and really optimize a sale to a coupon buyer, I have to look and see what are those core buyers paying for that type of yield today, right? And in the markets we're in Houston and also secondary markets throughout Texas, that coupon buyer is really looking for quality property at about a 5.5 or 6 cap. So the vast majority of our exit caps are around 6.5%.
Yeah, and so that's in Rob's scenario, and pretty much everyone's scenario is you have to be knowledgeable of your market. And like you spoke about, you're talking about different products. You buy a project day one, it's a value add, or, at least a light value add in most cases, where if you're selling a stabilized, which is obviously post business plan, you're selling a stabilized property, it's a different product, and you can't be shopping your property as a value add cap rate when it's a stabilized cap rate. It does not make sense to be able to do that. No one's going to be realistically buying that deal. It's trying to, basically sell up any product for a markup. It just does not work like that. So the key takeaway here is that the cap rate is pretty much something you can't control, but it is something you can project, and you have to be very good at being able to determine what exactly you're going to be able to achieve at that 5-year business plan. And yeah, so just keep that in mind. And now we're going to get into the NOI, the operating income, and this is where you can really start to pull some levers and figure out how to best increase the desirability of your property upon the sale. So so I guess, where do you start with that, Rob?
Yeah. And before I jump into that, I just want to add one more thing. I mean, there's a lot of wrinkles that you can always go into, but what I'll say is there's a lot of people buying deals with a sub 10-year horizon, but they're putting 10-year debt on the property with yield maintenance, which severely restricts the flexibility of the property. This isn't the end of the world because interest rates are very low.
So let's talk about yield maintenance for a sec, just really quickly.
Yeah, yield maintenance is a type of prepayment penalty on permanent financing, whereby if you wanted to prepay the loan, let's say it was a 10-year loan and you wanted to prepay the loan down in year 8, the lender would be entitled to the remaining interest payments of the 9 and 10 years based on where the treasury yield is at today. So basically, it's just a protection mechanism for the lender to ensure that they're going to receive the yield that they signed up for. So it's great security and call protection for a lender, but it impacts the flexibility of a borrower's ability to sell free and clear. And what often happens is these deals then have to be sold on assumption. And I don't mean to be too pejorative about yield maintenance, because what it does offer is, since you are providing such great call protection to lenders, they're willing to extend the most credit at the lowest price. So that is a difficult thing to turn down, right? So in the end,
yes.
and we've done this, we accept yield maintenance and take it on, knowing that it does limit our flexibility. But, like I was saying about low interest rates, when interest rates go up, the desirability of an assumption of your existing loan goes up. Even if you're assuming the loan to the next buyer at a low LTV, which is also unattractive, that can be overcome with a low interest rate. And then there's other reasons why an assumption can be unattractive, like there's no interest only period remaining on the loan, for example. But what I wanted to tie into the exit cap rate is, a lot of these deals are assumed, 5-year exit and 10-year Fannie Mae paper, and then they're just projecting an exit cap rate. But I think you should bake into your exit cap rate a little bit of a widening, due to the fact that you're most likely going to sell an assumption. And it's nobody knows where interest rates are going or where the market's going, but there's a decent chance that that assumption actually hurts your sale price rather than helps it. And so, as a way to combat that maybe overstatement of the business plan, saying, hey, guess what? My business plan says I'm going to put on really cheap debt, high leverage, and when I'm going to sell, I'm going to have no penalty for selling on assumption with no IO. So I think a good way, and by the way, if you were to sell free and clear at year 5, the prepayment penalty would be something like 10% of the loan amount, which would obviously be non-economic. So,
yes.
But a lot of people aren't projecting a 10% prepayment penalty on their exit. So I think a way to combat that, and if an investor asks you, you have yield maintenance, what's going on here? You say, I've widened my exit cap rate to accommodate a sale, knowing that a buyer will potentially want to purchase this property at a slight discount given the assumption. And we're actually in the process of buying a deal that we're assuming what I call broken financing, because it's suboptimal debt that we're assuming, because it's, dated Fannie Mae loan with no interest only, and it's already been amortizing for a couple of years. So it's amortizing. We're not paying, when we assume the loan at the present unpaid balance, we're not paying 30-year amortization. By now, if the loan has been amortized for 2 years, we're paying 28-year amortization. So people need to factor that in. And so anyway, that's a long way of saying there should be some other considerations in your exit cap rate to make sure that you have answers to potential questions. But
yeah, definitely. I mean, pretty much any type of tools that you're using to buy the property, you also have to consider those tools, how they could work against you when you sell it. Is a very watered down version of what Rob just said. If you're, like you said, using some complicated debt that was really useful to you at the beginning, you have to also realize that there are typically some tradebacks to pretty much every type of debt. Otherwise, everybody would be buying the same debt always, which is not the case. So to make sure you know the cons of that or any other type of tool that you're using, whether it's debt or otherwise, are essential to figuring out your cap rates and reversing those too. So yeah, so great point.
Yeah, and now we'll jump into the NOI side, and this is where things get trickier, and people can there's just more discretion to do different things. So when we say, oh well, an exit is simply calculated by your NOI divided by your exit cap rate. Well, what NOI are we talking about here? If we're projecting to sell at the end of year 5, are we talking about our year 5 NOI or year 6 NOI, T3 basis? And so there's just different things that go into it. And so I think first we'll just kind of run through the way that we do it, and that through talking to other institutional,
a popular way to do it.
Yeah, the conventional way would be to use a T12, your trailing 12 months projections. So essentially a full year 5 net operating income, inclusive of a replacement reserve, which is typically $250 to $300 per unit per year. And that will, if you use that as your NOI, that should be a pretty standard and safe way to calculate your terminal valuation. And what I'll say is the, not including your replacement reserve or including it, that could change your exit price by at least 3%. So you could be overstating your sales price by 3% if you don't include those reserves above the line, or at least in your terminal NOI calculation. The other one is property taxes. So
this is a big one.
Yeah, so sometimes you see people tax adjusting their projected sale, which would be basically you'd be looking at the residual value for the next buyer, and you'd say, well, if I'm going to project that the buyer will purchase at X price, typically in the market, properties get reassessed to maybe 80% or 85% of that purchase price. And so that's how much property taxes are going to go up for that buyer. Mm-hmm. And I think this is a great way to do things and very smart. We, for simplicity reasons, don't do it. It's the same reason why we used to calculate our terminal NOI with T3 income and T12 expenses. And I looked at it, and it was maybe 1 or 2% more aggressive than just T12. But even more important than that, it's just more complicated. And I want to keep things as simple as possible. And I just had the thought in my head, well, what if an investor asks me how we're calculating that? I want to be able to confidently say, well, we're just doing T12 NOI with reserves cap rate. So we took that away, and then we're also not tax adjusting the property. We're not doing any property tax adjustments. Instead, what we've done is we're tracking the property tax increase over the life of the investment to more accurately reflect reality, right? Property taxes, especially in value add deals where a lot of improvements are being made to the property, rents are increasing. The assessor's office, they want their pound of flesh as well. So they'll be increasing property taxes, depending on what county you're in, roughly in line with your income increases. So what we do is we try to roughly match that. And so that by the time our exit comes along in year 5, we're not necessarily adjusting to a future sale, but we've been increasing taxes all along the way in our operations.
That trend is continuing, basically.
Yeah. So hopefully we're not understating property taxes on a exit basis too much there.
Yeah. And that's an interesting point. If you can, project those like you did, you won't have this huge sting, and you might not be feeling it, during the operation of the property necessarily. But if you see that sting on a sale, because all of a sudden you're seeing this huge tax bill that the buyer's going to have to pay, which at the end of the day is probably what the seller has to pay, if their buyer's experienced enough to be able to, value the property the same way. That, yeah, it's smart to make sure that you're projecting it throughout the deal so that you can do that. So with this, I guess, NOI, you use your T12, you talked about replacement reserves, Rob. So you mentioned that could be a problem too. So let's just cover that quickly. Why not covering could be a problem for the buyer and the seller if no one's on the same page there.
Yeah, it's really it's really convention. And so replacement reserves are a reality of most loans where you're having to escrow up funds for recurring replacements, usually related to turnover. But just like I mentioned earlier, just if you don't include that in your NOI calculation, some people put that replacement reserve number below the line, which would mean they calculate their net operating income. And then in CapEx, they put the replacement reserve. So it doesn't, it's still showing up as a cash flow item, but it doesn't affect their operating performance. And this, in turn, if you're using a cap rate to generate a valuation based on that number, you're not taking into account that extra expense that you are actually having now and a future buyer will be incurring later. And so that's how typically properties are evaluated. And you might be projecting a sale of, if we're talking about a $21 million deal, taking factoring reserves back in, you might actually only be selling the property at 20.5 million. So it does affect your valuation, and it should be there. Similar with the property tax, like you said, on operations, if your property taxes are growing at 4% and you only projected 2%, it's not going to kill your deal. Right. But it will really affect the exit valuation a whole lot. It's just, if you look at a cap rate, call it a 5% cap rate, it's a multiplier. A 5 cap says your NOI is valued 20 times, or your property is valued 20 times the NOI. So any small change in income is 20 times exacerbated on the sale. Big levers. Yeah, it's a big lever there. So it's actually really funny. We had a seller recently tell us they had very low property taxes. And they tried to claim that because the property was set up as a condo, that the property taxes were very low because they are valued at the county level as a residential property and not a commercial multifamily. Sure. And he said, I'm so confident about this, I'll escrow up money, call it $300,000 for 3 years. And if your property taxes go up during that 3-year period, well, you can just pull from that escrow that I'll give you to cover that shortfall in operations. So we'll agree up front on a property tax number. And then if there's an overage, you can dip into my escrow here. And someone might say, oh, that's reassuring and that's nice. But whatever dip we're talking about in your operations via an increase in property taxes, let's say even if you eat up the whole 300,000, you say, okay, great, I was protected. But really, think about what that's going to do to your valuation. 4 and 5
are very scary. Yep.
So it's just crazy. So imagine your property taxes going up by $100,000 and you get to go into that reserve, but $100,000 times 5, right? We're talking about a big difference in your exit value.
Yeah. Like you said, if you ate up that capital, that escrow, on paper, you said, you saved $300,000, sure. And that was, guaranteed money that you could save on the property. But while, the early years by using that up was, stabilized and safer, that sale where you have to now catch up and then sell it at a loss, you might not be projecting that. And so you got to be very careful with something like that. And interesting scenario there. Yeah. Very interesting. I've never heard of something where he was so confident and willing to, lend that money out just in case. So yeah. As far as we talked about, I guess the stereotypical kind of valuation, you just take your T12 from the sale and then reverse that out with the cap rates at the time. So I guess where are the other different valuations that might come to a head where you're talking to a seller and they might be seeing a property differently than you, or a buyer rather, I guess, in this scenario? Because people talk in T3s, right? They talk, right. Some people even project, their trailing data, and they use that as their valuation. I've seen as well. So
yeah, well, I'd say just the scariest one that I've seen is if you're going to sell in year 5, I've seen people look at year 6 NOI.
Yep.
And so, and a model is usually growing at call their NOI growing at about 3%, right? So what they're doing is, in simplistic terms, they're taking their year 5 NOI, growing it by 3%, and then dividing it by a cap rate, which, it's just overstating the sale. And if you think about it also, which is kind of a funny thing, a lot of people look at exit cap rates in terms of 10 basis points per year or 5 basis points per year. So if we're going to hold the property for 5 years and we're going up by 10 bips a year, so we'll increase the exit cap rate 50 bips over going in, right? There's a lot of things wrong with that already, right? Going in shouldn't matter because, like we talked about, you're selling 2 different products. But the other point is, if I'm going to value at the year 6 NOI, I should also increase the cap rate by another 10 basis points if I'm going for an additional year. So there's just some interesting wrinkles there. And at the end of the day, we're getting, it's easy to get confused because we're just talking about 5% cap rate, 6% cap rate. These numbers don't seem that big or like they mean a lot. But if you just actually do a reality check and look at what the exit sales price is projected to be, we just like to do a sanity check. I mean, at the end of the day, when I'm looking at a model and a business plan and I'm saying, okay, well, we're buying at, 40 a door, 50 a door, and we're doing all these things in our business plan, and my exit cap rate is what it is. It's a 6.5 or a 7. I just sanity check and say, well, what per door are we exiting at? And is it at all, are there comps in the market exiting at that price today? Is this a realistic sale? It's good to just not only look at, is my exit price projected, does it make sense on a cap rate basis, on a price per door basis, on a square foot basis? So because there's situations where a deal, just given its characteristics, it may just not trade on a conventional cap rate, and its valuation is it's drawn down by its price per door. We've recently looked at a deal that was 1970s product that's really good, biggest units in the submarket. We're talking mansions, 1,400 square feet.
Wow.
These 3 bedrooms, 4 bedrooms. So this property is unlike any other in the submarket. It's really amazing. But the issue with that is you're talking about a 70s product in one of the best locations, but nobody wants to pay $150 a door for it, right?
Yeah.
But on a cap rate basis, that's like a 5.5 cap. So on a cap rate, it makes sense. But on a price per door, people would say,
it's looking large. Yeah.
Yeah, you're out of your mind.
Yeah.
So you might be able to buy that deal at a better than market cap rate because of that interesting dynamic. But that same dynamic that got you in at a favorable cap rate, you're going to have to project to sell because the market, again, will discount you based on the very high price per door.
Yeah, that's an interesting point too. Any advantage that you took when you bought the property, as long as it's a condition that will be there when you sell it, you should probably discount it just like you got the discount when you bought it. So yeah,
exactly.
That's very interesting. And we talked about, I guess, that year 6 valuation or the year after sale valuation. And I mean, at its core, it's really, like you say, if it's a 3% NOI increase, it's really just kind of inflating your sale price by 3%.
Yeah.
I mean, in simplified terms, that's what you're doing, right? You're assuming, I mean, maybe you're assuming the cap rate goes up a little bit, but you're assuming that the property should sell for more than it's worth today, which is not when it's selling. It's not selling a year from now, it's selling today. So it shouldn't be worth what it's worth a year from now. And I mean, there's justifications for that too. And there's, reasons why you might want to do that. Maybe, it's stabilized and under rent. So you can justify that it's, a conservative deal, and them putting that data on there is, still okay for you to buy at that. But yeah, to be a conservative seller and to make sure that your project is going to be good as far as, completing your metrics for IRR, whatever you're trying to complete for your project, you definitely want to be more conservative, I would say, and just make sure you're choosing the right data to broadcast your project and your apartment to whoever might be interested in the market. So
definitely. I also think what methodologies you use here can be indicative of your overall attitude and
yes.
your overall,
overall attitude for your business plan and everything. Yeah.
Right.
You could be an aggressive person kind of going for aggressive numbers or,
yeah. So, I think you want people to be aggressive on their operations and really try to maximize their performance of the property, but be conservative on the modeling side and on the projection side. And so there's really 2 types of projections, the operational and non-operational, right? So something like vacancy rate, that's an operational assumption. And those things you can be proven wrong pretty quickly. So if you say, well, in year 1, we're going to have an 8% vacancy rate, and you end up at 10 or 12, you were wrong pretty quickly. And so on the other hand, if you say, well, we're going to sell at a 5.5 cap in year 5, you've got 5 years down the road to be proven wrong. So it's really a safer bet to if you're going to be aggressive on one thing, be aggressive on those non-operational assumptions, because those are in certain cases less likely to get you into trouble. Whereas operational assumptions, like we're going to raise rents $100, we're going to increase occupancy by this, and our expenses, we'll run this thing lean and mean. And if it doesn't happen, you might be getting into trouble on your debt service coverage ratio, and it's just a lot more stress on you than saying, we're going to sell at a 5.5 cap and you end up selling at a 6. At the end of the day, that was somewhat out of your control.
Yeah, I mean, boils down to if there's something that's in your control and you kind of miss the mark, that's poor planning on your part. But if there's something that is out of your control that you missed the mark on, it's just bad projections, really, I guess is what it that's kind of maybe some verbiage that I could have explained better. But, if it's out of your hands, stuff does happen, market cycles change. So you do your best, but nothing is perfect. So it's a little easier to explain that, I guess is what I'm saying, is versus something that, you had a hand in versus,
Right.
you didn't hit your rents or whatever it may be. So,
Yeah. So we recently have started to include in our quarterly reports our acquisition underwriting, and we'll say, okay, well, this is how we underwrote the deal for this quarter. And let's say it's, the first quarter of ownership or the second quarter or even years down the road. We'll just continually refer back to our acquisition underwriting and say, here were our revenue, expense, NOI projections for this quarter back when we bought the deal. And then how are we doing, what's the underwriting to actual? And then similarly, we're also looking at our underwriting to our budget. So initially, when you first buy a property, your budget and your underwriting should theoretically be very similar or the same. And then as time goes on, your budget gets updated every year as you're informed by the market and the property's performance. But your acquisition underwriting, that can't change. That's just the same when you bought it. And so it's interesting to look at how your budget changes versus your underwriting, and whether that things are doing better than you expected or worse on an actual and a budget. So that doing this has not only been very illuminating, but it also keeps us very honest. And we can't just feel like we can throw whatever projections we want together and then not be held accountable. I think that's something very helpful for us while we're underwriting.
Yeah, showing the iterations will really break down and be more transparent for everybody involved. You can see, more frequently how accurate or inaccurate everything is. It's definitely interesting. So I guess back to the valuations, what else can we talk about that is kind of good for a seller to know as far as what to expect when they're getting ready?
Well, I'm not sure about what to expect, but just looking at, what you're projecting and how that affects your sale. One of the big hot topics is rent growth. And a lot of people will say, well, rent growth is very aggressive to project at 3%, 4%, whatever it is. And they're right. But I don't know if they're right for the reason they think they're right. Rent growth doesn't necessarily make the projections overly aggressive from an operation standpoint, but it's from your exit standpoint. Because when you project 3% rent growth every year for 5 years, your revenue goes up, but when you go to sell, it really juices the returns, and that's where you see the boost. So, we see a lot of times when we're comparing different scenarios and say, okay, 2% rent growth versus 3% rent growth, that can result in a pretty big change in the projected sale price, which is where all the all that excess return is really created.
Yeah, and I've spoken on this before. Just in general, one of the biggest levers, or it is the biggest lever, pretty much always, is your rent growth and just your rents coming in on your NOI. So, moving that lever, projecting that is huge. So, like you say, if you're gonna 20x that on the sale on a 5 cap, like we spoke of, so if you miss by $1,000, that's $20,000 at sale. Now, instead of 1,000, picture it being 50,000, 100,000 on a huge property. That's millions of dollars that you're missing the mark on the sale, which at the end of the day, the sale is going to be a large part of the return of capital for investors, whether it's limited partners or general partners, everybody involved. The sale is a huge contingency on the whole success of the property, and the cash flows could be great through all 5 years, but if you miss the sale, it could really kind of diminish the overall return. So to miss that mark on the biggest lever in the NOI, and then to lever that again with the cap rate is definitely got to be careful with that.
So that dynamic between the rent growth and the exit cap rate. So sometimes we want to project 3% rent growth because we feel very strongly about a market. Sure. or a particular property, just depending on what location we're buying in. And when we do project 3% rent growth, we are cognizant to increase the exit cap rate because we want we don't want to overstate everywhere. If we're overstating or you're being aggressive on the rent growth, we at least want to be more conservative when we're going to sell the property. So that's just something to note. When we're being aggressive on rent growth, we try to increase the exit cap and dial back that sale price. And you can actually kind of optimize it so you can project a sale equal to as if you projected only 2% rent growth, but have 3% rent growth baked in, so that at least you're reflecting that aggressive assumption or your confidence in the market in your operations.
Yeah, that's a smart way to hedge your bets, and we can kind of go over that scenario once we get into the second portion of this, where we'll do maybe like a 2% to 3% and keep the sale price the same, but show the rent growth that you want to bake in to kind of show the actual, projection of the property, because maybe that is more realistic for that market, is that it will be a little higher rent growth, but you also don't want to be too overzealous when you sell it. So that's a very good point, and very simple but logical way to make sure you're being safe.
Yeah, so. And if you look at it too, a lot of rent growth is tied to inflation.
Yep.
So inflation not only increases your revenue, it increases your expenses, but also inflation is one of the biggest influencers of treasuries. And all financial products are tied to risk-free rates or treasuries, and real estate is normally tied to the 10-year U.S. Treasury yield. And with if inflation goes up, then your rents might go up, but then the 10-year goes up, which then increases the cost of debt, which then pushes on cap rates. So it would make actually a lot of sense that if you are seeing outsized rent growth, that your cap rate would expand a bit. So that's the logic there as well into the financial markets. So then two other interesting things about, you mentioned rent growth being just the most aggressive or the
biggest lever.
Yeah, and the other really big lever that nobody really talks about, and depending on how you build your model, it could be even bigger than rent growth, is your stabilization time.
Yes, definitely.
So there's a lot of opportunities and business plans to go in and programmatically renovate units and raise rents. And that can really, obviously, that's the juice of your deal. That's where you're getting the upside. But completing that business plan in 12 months versus 24 months could be a huge factor in your IRR calculation. So I think that's something that we have personally learned lessons from, and we're trying our best to not be aggressive and kind of sanity check that assumption, saying, because we've had investors ask us, say, well, are you really going to get all this done in 15 months? How many units are you trying to do a month? So, and you're trying to maintain this occupancy. So I always like to look at, okay, if we're trying to maintain, call it an 8% or 7% vacancy, how many units does that leave us available at any given time? And then factor that into how many units we can roughly renovate a month, and just kind of sanity check our assumption to stabilization, and then bake in a couple months, obviously, just for extra time. So I think that's a big one. And then the other thing that's interesting is changing the hold period. So we typically have two different hold periods for which we look at: 3-year holds and 5-year holds. It doesn't mean that we must sell in 3 years or we must sell in 5 years, although we and our investors would like to. But sometimes you have to hold longer because of market dynamics, or your business plan is slower than you anticipated. But it's really interesting to look at how the IRR changes based on your hold period. So, if you just look at it from a math perspective, if you sell in year 3 versus year 5, you're capitalizing on that equity appreciation a lot sooner than year 5. And if you're using an IRR, right, you're being discounted at whatever the IRR is, 15%, 20%, and that, cutting off those extra 2 years will really juice your returns being on selling in a year 3. And then so what that means is, hang on a sec. What that means is when you also sell in year 3, your projected sale price is lower than in year 5 because you're taking away those additional years of growth out of your model. So what you can actually do if you project a shorter hold period is you could project the same or higher IRR with a lower projected,
You're good, man.
With a lower projected sales price. So that's really good if you have investors who are very price per door sensitive or very price sensitive. You can project a shorter sales price or shorter hold period and say, hey, look, I'm selling at this price versus the 5-year price, and I'm still hitting the returns.
Yeah, it's interesting. Yeah, where you get that bucket of money on the sale versus how much it is. Yeah, it's definitely all the things to consider. You mentioned too, just the stabilization period, where that might not directly affect the NOI at the sale price, because obviously most scenarios you're going to be selling a stabilized property. You should be getting debt longer than your stabilization period and your even expected exit period. But that still can affect the IRR, because if you take a longer stabilization period, all of a sudden your IRR comes down. And then if your sale price was aggressive too, I mean, it all plays together, that you have to make sure that if you're going to be aggressive on one thing, like you said, to make sure that the sale especially is going to be a little more conservative, or vice versa. Maybe you can get away with the sale being a little more hopeful if you're super conservative on everything else. So just taking it all into account, because they all play together, sometimes not so nicely. So you got to be careful. It's definitely key. So lots of good stuff. I think we're going to get into it now, is the actual second half of this portion, which is generally better to watch on YouTube, on our YouTube channel, where we're going to get into Rob's Excel model, and we're going to start playing around with the numbers and seeing what you can do as far as we talked about these contingencies you can make, and just play around with cap rate, changing those around, just all this stuff that we talked about. We're going to actually show you some real numbers to kind of show you what actually happens to these IRRs, these sales, all that good stuff. So if you're listening on a podcast, whatever it is, iTunes, Spotify, Google Play, might be a good time to pause and then pick it up on YouTube, or you can listen in, but it might be a little bit harder to keep track of what we got going on. So stay tuned for that. So here we are now. We're checking out Rob's actual underwriting spreadsheet. We're on the summary tab right now. You can see we just kind of got a synopsis of a example property. So Rob, let's just start where we take into account the NOI and the cap rate. So just start, I guess, playing around those to see how they kind of play with each other, whether it be nice or not so nice in some scenarios.
Yeah, sure. So this is just a hypothetical deal, and as you can see, it's not a bad deal on an unlevered basis. It's not great on a project, and then net of fees, it's not really what most people are expecting. So this isn't a great deal, but we'll take a look at the numbers and then see if we can play around with it and magically transform it into a great deal. So let's take a look at the pro forma. And so this is very standard pro forma with the revenue, expenses, and then here we have NOI. And the one thing that's just to point out is the replacement reserves being included in the OPEX. So the operating expenses are inclusive of this $300 per unit per year number, which is almost $69,000. So this $69,000 is factored into this NOI number. And if we just did a back of the napkin calculation, say, okay, well, 69,000 divided by, for this deal, we're using a 6.5 cap for now. So let's use a 6.5 cap. That is actually $1 million in value. So one quick and easy way that we could increase our returns, or get more aggressive with our projections, is we could omit that, and actually, just to prove it, what we can do is we can look at the projected sale price of 18.6 million, and we'll just set these reserves to 0, and then the number should roughly work out to be 19.6. So there was that $1 million difference right there. So so that's actually the power of reserves. They can do quite a bit to your exit valuation. And if you look on a operating basis, they're not going to kill your deal, right? Another 69,000 in expenses on $1 million of NOI is not a huge deal, but that $1 million of sale price is obviously a huge driver in value there. So it's not only important to factor in those replacement reserves in your valuation, but also, to include them above the line and in your valuation. And another thing too is you could, if you wanted to, for this purposes here, we're assuming that all those reserves get spent, which is pretty conservative, especially with a value add plan where you're coming to the deal with a CapEx budget. You're going to be fixing a lot of those replacement reserve items that would ordinarily be used from that reserve. So a lot of these deals end up having a big chunk of replacement reserve there just sitting, and it's just a way to be conservative. But you could, in effect, below the line here, use a negative expense for capital expenditures, for example, to assume getting some of that money back. Or you could project it on year 5 to get it back at sale. So that's the first point about the reserves. And then the next point is when we're actually calculating what the sale price is. So I'll scroll down to here where we calculate the property value upon sale. This is being calculated by taking this NOI directly above it for year 5 and dividing it by our projected exit cap, which, like I mentioned, for this deal is 6.5. So, but you don't necessarily have to use year 5 T12 NOI to calculate this terminal valuation, right? Some people use actually the forward-looking year, which in this case, because our operating numbers are conservative, it's not a big difference because you can see the difference between year 5 and year 6 is just 1%. So that's not going to overinflate the sales price much at all. But if we start pulling some levers, we can see how this can quickly escalate. So let's start off by, I don't know, should we go crazy and just start pulling a bunch of levers and see how high we can get the price to be?
Yeah, I like it when it's dramatic so you can really see the effects, so it's, more clear to see it. So yeah, I guess you just talked about kind of the forward projection. So maybe let's take that year over year and increase it and see how you can get into dangerous waters maybe.
Yeah. So what we'll do is we'll increase the rent growth and decrease the property tax increase. We can maybe touch on that later, but by changing your growth assumptions to this typical 3.2, you can see now, not only will you be growing year over year faster, but now the difference between year 5 and year 6 is 3%. So now that is worth something. So if we wanted to override, well, already our terminal is up to 20.5.
Right. And then so compare that to say now we're at a 20.5 on a year 5 if you did a kind of normal T12 valuation. But if you look at the year 6, which you'd pretty much be pulling that year 6 valuation on sale into your year 5 if you use that forward year valuation, you can see that delta is, $700,000. That's a big chunk of change that if you're, forecasting poorly and then being aggressive on that year 6 valuation, that's a big oversight that could be, dangerous waters to be treading in. So
definitely. And so if you look at here, we've already squeezed that return up to 16% on a project basis. And we've pushed the price per unit to 89.5 per door, which I think it was around 81 or so. So now we're really getting aggressive with our projected sale price, and we can just quickly demonstrate what you mentioned. If we just assign the year 6 value to year 5, which is not uncommon, many people actually do this, you can see it went from, hang on, I guess I'm not calculating via there. So let's break into the actual calculation.
Yeah, you got to do your monthly.
Got to go in here. So basically what we're doing is we're saying this calculation here is no longer based on year 5, and it's based on this year 6 value, which then increases it to a 14% net IRR. And if we also change this, it goes up to 17.2. So it's about 120 basis points increase from just that one slight change. And 100 basis points on an IRR is, difference whether you might do a deal or not. So that's a big one. And then, like we showed, this reserves number, this is dramatic. Now we go do that as well. And now we're selling at 94 door, and now we have a 20 IRR. So this deal went from, I forget, it was 12 to 20. Is pretty incredible. Just all based on the sale.
These small changes that, as individual assumptions might not be dangerous, but if you start stacking these up on top of each other and not protecting yourself in other ways in the project, you can see how this could look great. And if this is accurate, then obviously you're doing, if this is an accurate portrayal of the project, then you have a great deal here. But make sure it's right when you're stacking all of these hopeful assumptions on top of each other, for sure.
Yeah, and what's really interesting, like we talked about earlier, a cap rate is kind of in plain sight. So we're still evaluating the property at a 6.5 cap on exit. So the exit cap rate didn't change, but we were able to change the projected sale price from 18.5 million to 21.5 million without even changing the exit cap rate. So just confirming and seeing if the exit cap rate matches your expectations is not enough to actually understand, to actually believe in that sales assumption. So you actually have to look and see, well, what is driving that NOI number? And then at the end of the day, sanity check and say, well, is 94,000 per unit for this property in 5 years, does that make sense?
Is a buyer going to want to buy that? Yep.
Yeah.
So Yeah, let's so that was a good demonstration of pretty much, increasing your NOI by, well, we reduced what? We increased taxes, or we reduced taxes, and then we increased your rents. So yeah, it was a great way to kind of see by kind of doubling up on your assumptions that you can definitely change the scope of a project or what you're assuming is the scope of a project. Do we want to get into, maybe we talked about tax rates and maybe how we spoke earlier with you change your tax rates year over year, but then you can also, use cap rates to kind of make yourself safe too. Just kind of get into maybe protecting yourself with your cap rate assumptions.
Yeah, so it's easy to kind of get lost in the numbers when you're talking about, well, a 6 cap or a 6.5 cap, and debate those numbers, and they don't necessarily seem based on reality sometimes. And so it's easier to look at just a plain number like projecting to exit at 89.5. And so let me first dial this back to the 2% rent growth, right? And just show what that does. So that brought the per unit price all the way down to 84.5. And let's just say that's the number from your analysis, and you feel comfortable with, you can say, yes, we will exit in 5 years at 84,500. That feels right. We're being safe here. So and then on the other hand, let's say you also feel strongly that this is a great location, and you think that this market is going to grow at 3% on the rent growth. So you can do that, but now you're no longer feeling comfortable with your exit price. So while you feel comfortable with rent growth at 3%, and you want to be able to show your confidence in that number because the market is good and give it that credit, you don't feel comfortable saying, well, people are going to be willing to pay nearly 90 a door for this product. So oftentimes what we'll do is we'll dial back the exit cap rate, maybe 25 bips, and now I'm down to 86,000, which is closer back to what we were forecasting back when the rent growth was only 2%. So that's just the dynamic there to bring that number back in and have it make a little more sense.
Yeah, and we spoke about how the cap rate is really just, you're subject to the market and what cap rates are trading at, and that a lot of times can come down to sentiment of what someone's willing to pay per unit. In this case, if you look at your per unit cost, when you break it down into, say, yeah, maybe that almost $90,000 was too much for a buyer in 5 years. Yeah, you got to put some sense into the numbers. So like you said, if you got to adjust by, 20, 30 bips or whatever the case is, to make sure that you're looking at the sale price, whether it be per unit or total, it should also just make sense to a buyer at that point and not just reversing your NOI and the cap rate, because the cap rate is a metric of market sentiment. And if they're not willing to pay that unit price or that total price, then the cap rates will change. So you can't just assume that it's going to stay the same too. So
you also asked about property tax increase.
Yes.
So this was something that we're being more attuned to, especially in the Texas markets, and I'm sure other markets where the assessor is seeing the values go up and up and up, and they want their piece of that pie as well. So they've seen property tax increases similar to value. So looking at the pro forma based on this business plan, obviously every business plan is different between raising revenue, decreasing expenses, and all of that. But if you look at, for example, our effective gross income increases are 4% in year one, then 6%, 3%, 3%, 3%. That's obviously just that rent growth assumption. If you're going to project these growth assumptions, you would also want to have a similar growth assumption there for your property taxes. So, this business plan doesn't call for tremendous growth in the revenue. So maybe, we like to usually use 5% as a proxy for the growth there, but for this deal, you might only want to put 4. And so what I'll show you is, okay, so if we look at the investor returns here, 11.7% and selling at 86,000 per unit. But if I jump this to 4%, now it goes down to 11, and I'm only selling at 84,000. So you lost 2,000 per door there, and a little bit of IRR. So that's something a lot of people miss, and I think it's really important to actually forecast that property tax number, and especially for the bigger value adds where you're really adding a lot of revenue to the property, you can expect the property taxes to increase a lot as well.
Very hard to hide what you're doing if you're, employing a project on a property and increasing the revenues. And I mean, it's very easy for the municipality to see what's going on there. So they're gonna, eventually be able to access what you have going on through taxes. So yeah, you have to project that. And in this scenario, that 2,000 a door might not seem like a lot, but when you have, say, 100 units, 200, 300 units, I mean, you're multiplying big numbers now, so you don't want to miss those marks.
Yeah, exactly. So those are just some of the levers that I think are important and that they drive the exit valuation because those numbers are compounded over typically 5 years. So going back to our usual metrics of 2% rent growth, 2% expense growth, and either 4 or 5% property tax increase, you can see going back to the pro forma on an NOI basis, once you stabilize out, right? Initially, obviously, there's a lot of growth through reducing expenses and raising income. But once you stabilize out, you can see that the NOI is really only growing at 1%, which I think that's a very safe and conservative assumption. And you're really not deriving much of your returns. So the returns you're showing investors, there's not a lot of growth embedded in those returns. So you're not really betting much on the market to achieve your returns, and it's all based on your business plan. Another way that you can achieve this, and is also an interesting way to look at deals, is changing the holding period. So if you look at, if we jump down here to the property valuation. So in year 3, you could sell for 17.7. Year 4, since you're getting a little bit of an increase, it's 18, and then 18.2. So really, there's not that much growth. So let's just say that these prices are pretty much the same from years 3 to 5. But let's see how that returns are affected via the sale. So right now, 11% project level return over 5 years. But if we go and change the hold period to 3 years, let's see, it went down to 10. So this is interesting. And this is partially due to the fact that the property, this business plan and the model hasn't fully stabilized out in time to really maximize the returns, which is somewhat unusual. So, and if I go like 3% rent growth and bake in more growth, this should be a bigger number. Now it's 12.1. And then if I show 5% here, this should be, well, it actually keeps growing. So that's interesting. So even though we're holding the property for longer, right, which means you're discounting the returns by more years, because you're embedding more growth, the returns are larger. So conventionally, when you usually think about returns, you think, okay, well, if I can maximize the value of the property and then exit, the sooner the better. Because the longer you hold, you're just clipping the coupon and you're eroding that IRR. But in a case where you're actually factoring in a lot of growth, which invariably most people are doing that these days to win deals, they're factoring in 4% rent growth and low expense increases and low exit cap rates, the returns will actually get better over time, which is pretty dangerous because the longer your hold period, the more time those assumptions of yours have time to compound. So it's
not guaranteed money either. If you haven't cashed out, then you literally haven't, received all the capital out of a deal.
Right. Even a 5 or 10 year hold, you're banking on much of your returns coming in year 5 or year 10, which is, obviously less certain than making money from operations. So something we focus on a lot is looking at, as one of the many different sensitivities analyses or stress tests, is we're looking at return from cash flow. And so we want to see a good, healthy chunk of the returns coming from cash flow, and that we're not banking 100% of the returns on the appreciation.
Yeah, so with these levers, you had a slightly different scenario here where it was actually trending the opposite way as far as IRRs go in regards to what you could maybe expect on a deal. But one of the kind of takeaways I get, at least, is that you really don't want to get out of a deal too early, especially if you're in the growth phase, because you're going to be losing a lot of that appreciation on the property and then just the cash flows in general, like you spoke of. So while you're in that growth phase and you have projections that you'll be able to continue to grow, it might make more sense to stay in the deal and capture that IRR versus trying to sell and get that, that giant payday a little bit early. While that would guarantee you money, it might not make business sense in the sense that if you are, appreciating that quickly, that you're actually losing on the actual total return. So yeah, definitely some interesting ways to play around with that.
As an example, we could just change that exit cap rate to 6, and that'll basically drive more returns on exit because you're just selling at a higher price. And then don't want to be wrong, but I'm feeling pretty confident that over a 5 years, we're at 18%.
Yeah.
Over 3 years, since you're monetizing that cap rate arbitrage between
higher, way higher sale differences now.
So there you're at a 20. So there is where the numbers make sense. And ideally, that's the type of dynamic that you're looking for, that you've created so much value that the sooner you exit, the better, rather than being in a deal where you're kind of stuck holding for longer, trying to earn that return that you're looking for. So, and sometimes that's just what you have to do. Sometimes, deals that are bought, right before a recession or something like that, it just takes longer for that growth to happen. Or, if you're buying really early in the cycle, there's actually a lot of benefit from holding.
Well, just fundamentally, I mean, if that you lowered your cap rate there, right, Rob, just to kind of play with it this way. So when you have a lower cap rate like that, you can see how, moving that sale earlier is going to affect your IRR in a positive way. I mean, with a lower cap rate, you're really just buying money at a lower rate. So it makes sense that you want to inject a value add business model to be able to sell it and get your money that way. But when we had that 6.75% cap rate, you saw that you're really buying money at a higher rate. So it's almost like you're buying a more long-term product in a sense. So it's just interesting to kind of see where cap rates in a market, and obviously, the product that you're buying is dependent on that. But when you're buying at higher cap rates, it's almost, even in a value add type of situation, it still is going to make sense to maybe stretch that out a little bit longer just because of the cash flows and the appreciation that's available to you at the time. So it's really interesting to see that too.
Yeah. And something and this can go into a discussion for another day for sure, but looking at return on cost or yield on cost, because a lot of investors have just gotten sick and tired of the different IRR calculations and how easily it can be manipulated. I mean, we only focus on one aspect here, which is just the reversion, and you can see how quickly you can manipulate it. And so the thing that I like to say is the most difficult to manipulate and the truest indication of the return is the unlevered yield on cost here, which is calculated here by just basically your stabilized NOI assumptions divided by the cost for you to create that stabilized NOI. And that would be your purchase price plus your CapEx, as well as any interest reserve if you have negative cash flows to carry you to that stabilization. Like for a development deal, for example, you'd have land cost, hard and soft costs, and then carrying costs of carrying the construction loan until lease up and profitability. So those would all go into what's the denominator of cost, and then your return on cost would be the stabilized NOI. And this plays no games, because in this calculation, there is no rent growth. There is no property tax increase. There is no exit cap rate. It's just that NOI divided by your cost. And so what we're looking for deals that have a big spread over the return on cost versus the projected exit cap rate, because that means we have embedded value created into the property. And like you mentioned, in places where there isn't such a big gap, there is no real rush for sale, because you haven't created outsized value between the cost to create your NOI versus what you could sell it for. If you could create income at an 8 cap and sell it at a 6, that's an arbitrage you'd be happy to capture. But in this type market, if you're buying deals more so because you believe in long-term growth prospects and good bones and things like that, then your return on cost may be fairly close to your projected exit cap rate. And at that point, it's just, hey, we're in this for more so the long term.
Yeah, it's really interesting. I mean, everything is deal dependent. That's why we kind of like to bring this spreadsheet in for this series, just to kind of show you how many variables there are. I mean, just look at the spreadsheet, how many tabs we have, 8, 9, 10 plus tabs to pull all these different levers and push these buttons to show you kind of the different scenarios here. So what else can we do? We did tax rates. We did rent increases and expense decreases to kind of really show how that can really lever up an NOI and the cap rates.
I think that's all I would really want to share for now. Okay. I mean, we could discuss the idea of the property taxes being adjusted for the sale, similar to how we adjust our cap rate that we're buying at. So for example, this deal, you're looking at an adjusted trailing cap rate. And what this number is it's the in-place revenue minus your pro forma expenses, inclusive of reserves and inclusive of what you're forecasting your tax bill to be, right? And so we typically like to aggressively forecast a big increase in taxes because we're buying the property and because we're projecting to add value. So in this example, I don't know what the in-place property taxes is because it looks like $398 minus a $20,000 refund or something, so $360. So here we're not projecting a big increase because our purchase price is so low, but typically we're 85% of the purchase price, which is going to be much higher than in place. And what that will result in is a discount to what the seller might say his cap rate is, because he's basing his cap rate on what he's paying for taxes, which is usually less than what you're forecasting. So an adjusted cap rate gives you a more realistic example of what you're buying. Because
what's going to happen to you, not what the seller's experiencing today.
Right, without changing the income, because we're saying, well, the income, it is what it is, and it's a lot harder to change than it is your expenses, right? If you're going to staff a property differently or spend differently on marketing or something like that, that is instant savings. But on the income side, it takes a long time to actually renovate, raise revenue, increase occupancy. So I guess what I was pointing out was how we adjust as a buyer, we adjust our cap rate that we're buying at based on property taxes. Some people, when they're selling, will also adjust and say, well, if I'm projecting here a sale of $20.5 million, I'll also want to factor my taxes at what the buyer is forecasting them to be at. So let's say that's at 85%, you're saying, okay, well, they're probably going to project an assessed value of 17.4 million, and let's just say the tax rate is 275. So they'll include 480 as their property taxes in their sale price, even though they're not paying 480 in year 5. Let's just see.
They just know that's what the seller is going to be expecting as well.
Right. So you see here in year 5, we have 460, and 480 is ostensibly what the buyer would be underwriting to, and they would adjust that NOI down to reflect that. But personally, we don't do that for simplicity reasons, but a way to kind of split the difference is to use a more accurate and aggressive property tax increase, or conservative, you could say, and that gets you closer to that 480 number.
Right. Like we talked about earlier, instead of being surprised year 5, you just make sure the incremental year over year is more in tune to what you can kind of see when you sell for the buyer. So that's a good way to do it.
Yeah, exactly. Like you said, rather than being surprised, it's in a way, it's even more accurate to reflect it in your operational numbers, because you'll be seeing that.
Well, if you ever got hit too, I mean, then it would be baked in and you'd be good to go. But if you have a year where your taxes remain lower than that 5 and they don't adjust as quickly as you're adjusting your NOI, then you're making, a delta there. But if they do decide to hit you pretty quick, then you're safe as well. So twofold there. Excellent. Okay. I think that's pretty good, Rob. Like we said, we pretty much covered, raising the NOIs, playing around with the cap rates to see how quickly those can change a deal, in a drastic way, covering how, like we just did with, the taxes, to see how you want to kind of prepare yourself for that and not be surprised. A lot of good stuff, and hopefully you guys got a lot out of it. We'll be on next time. I don't even know what we're going to be talking about, but we'll figure it out. So until then, see ya. Thank you for listening. This has been the Making Money in Multifamily podcast. If you have any questions, comments, or would just like to connect, please feel free to check out the show notes for how you can connect, or visit longviewacquisitions.com.